going to start the conversation, plan on having the conversation run for up to 2 hours tonight. We are going to be hosting this somewhat open-ended discussion on Howard Marks' collection of his investment memos, The Most Important Thing. And it was published almost a decade ago, but I think even then there's a lot of wisdom in there that holds very true through to today. And interestingly enough, he published a memo just this morning. So we'll definitely discuss mostly the contents of the book, and if it's appropriate to weave in some of the memo from today, we will. I do want to just get a disclaimer out of the way and a little bit of an introduction to Wook out of the way before we dive in to the discussion. So first off, I do just want to make sure everyone is aware that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. So with that disclaimer out of the way, just like a little about us, Wook Capital is a private investment fund. We are concluding our first year in operation. We just kicked things off this year. We do deeply believe that the path forward for achieving outperformance in the investment sphere lies in this novel realm of social media and retail investors. And part of our thesis involves collaborating with retail investors to crowdsource equity research, uncover overlooked information, and develop actionable investment insights. So filling in the blanks is something that's both part of our logo with those little O's in the center of Wook. Filling in the blanks together with retail investors is a vital piece of our thesis, and with the goal, of course, to achieve long-term investment outperformance. So I think there's a lot of great investment themes in the book and some great learnings to be had from the book. I know John is going to be joining us shortly, and I'd love to, before we get too deep into the conversation, have him share some of his thinking around why we opted to go with this book for our second book club. Our first book club is available on our YouTube channel, Wook Capital, at Wook Capital. We hosted that a little over a month ago. Our plan is to continue to host these on a monthly basis as part of the social programming that we're putting out, and our view is that really anybody can be part of this investment community with us. We understand we certainly don't know everything, and we're hoping to learn and grow as investors with our fellow Wookiees. So our Richer, Wiser, Happier Book Club number 1 is available on YouTube. This replay will also be available on both Twitter and on YouTube for folks who miss it. But we definitely value any feedback after we wrap on this conversation today. So I pinned a thread here at the top, and while we wait for John to join, there's a lot of great information in the book. I think there's some key takeaways, and I think we'll start the conversation going over some of those key takeaways that I think are captured in the thread. And then, look, I don't want this to be me talking the whole time. I want anyone who's listening to feel comfortable chiming in. There's certainly no wrong or right answers. We're just going to talk about kind of the different themes and takeaways from Mark's novel, his collection of investment memos, and yeah, just kind of hear different people's perspectives and hopefully learn a little bit together. So some of the main takeaways of the book, again, before we dive too deeply into each of them, just kind of overview the first discussion points I think we'll go down are really talking about risk first and foremost. What is risk? What isn't risk? The importance of understanding it of recognizing it and what can be done to control it. We'll talk about the importance of cycles, and like Ray Dalio, Howard Marks also is a believer in this empirical truth that everything is part of a cycle. Things move very much over long cycles, and being aware of where one sits within these cycles is an important tool to prospectively give an investor edge in their decision making. The importance of being cognizant of psychological influences. I think most of us could definitely agree that some of these influences, like greed and perhaps envy and ego, might have been a little bit larger in our existence and our investing thinking in the past couple of years than they should have been. And obviously, the market in December 22 today, as we have this discussion, is quite different than it was 12, 13 months ago at the all-time highs. But I think we can have some interesting discussion around the importance of being cognizant of the psychological influences and ways to mitigate those. A fourth theme is the importance of contrarian thinking. And I think a very vital takeaway from the book, very early in the book, is that if you're going to do things the same as the crowd, you should expect the same returns as the crowd or whatever group it is that you're lumping oneself in with, and kind of the importance of not simply going along with what the crowd is. I think there was a line in one of the summaries I saw about the dead fish all the dead fish swim downstream together, so to speak. Fifth, from a theme perspective, the role of chance and the importance of protecting your downside. And no matter how good or bad of an investor we may or may not be, there is an irrefutable existence of chance in what drives outcomes. And I think there's some important discussion on not being hyper-focused on just the outcome, but being more focused on the process and what can be done to ideally achieve more positive outcomes and minimize the risk of chance, and not maybe let good outcomes driven by bad decision making inflate our ego, going back to that psychological influence part. So that's, I think, the themes that we want to talk through first. Joe, I see John still hasn't had a chance to jump on. His call's running over, but in line with those takeaways, maybe do you want to add any color before we dive into risk?
Yeah, I mean, it's almost sad to think that a big lesson of the book is, the market's priced almost everything you can think of in. So unless you have some key insight, and we talk about a lot about the second level thinker, what does the consensus think? What's the probability I'm right? And then also, I put this in my Twitter thread I had tweeted out earlier, is the consensus psychology that's incorporated into the price too bullish or bearish? And I like how he mentions the second level is essentially like understanding that a company may be good and it may be a good investment, but if it's priced as if it's a great investment and it's a great company, then it's not such a good trade to jump in at this point. So that was one of the biggest takeaways I had, and I really appreciated hearing that because there are a lot of companies out there like that.
Yeah, that's a really vital point to recognize from the book, that in Mark's view, there's no such thing as there shouldn't be. We can talk about some of the reasons why things go this way, but there shouldn't be any investment that's great at any price, right? It could be the best business in the world, and even so, there is an intrinsic value that fundamental analysis should allow us to come up with a rough estimate of, and that there's certainly no reason that business, even if it's the absolute best business in the world, should be worth infinity, because that's just not how the math works. of the discounted cash flows of that fantastic business. And on the contrary, there could be really poor businesses and really ugly businesses that can be deeply undervalued because for a variety of reasons. Again, we can delve into them as the conversation goes. They represent incredible value because the discount to that intrinsic value is so steep. And a lot of this inherently involves subjectivity. Your point about second level thinking, it one of the first comments in that chapter of the book is that investing, like economics, is more art than science. We can certainly agree that even if we know all known available information, that still doesn't guarantee us the outcome that we desire in a good or bad way. So again, I have Joe and myself up currently. For those unfamiliar with my voice, I have my personal account at Rod Alsman in as a listener, but I'm the Wook managing director, and I'm handling our profile today and kind of leading the discussion. But we certainly don't want the discussion to just be between the Wook teammates. Han, I see you in the audience. I'm going to invite you up as a speaker as well. But anyone in the audience is certainly welcome to chime in and raise their hand to be a speaker and be part of the conversation and discussion.
Yeah, I will add on the point I had actually just made. GameStop, when I first invested, Rod, you invested much sooner, but in late 2019, late 20, was it 2019?
When I first invested was 2017.
When I first invested, I'm getting the years mixed. I invested maybe 4 months prior to the events of January. And it was priced as if the company was terrible. And you look at the short interest, it was priced as if the company was imminent bankruptcy. And in reality, it was a bad company, like fundamentally flawed in the modern era. So it's like kind of the opposite of what I was just saying. When a company's priced as if it's great, when it's only good. GameStop was bad, but it was priced as if it was terrible. So that's where the opportunity lied. And you looked at everyone that participated in the Roaring Kitty streams. No one agreed the company should have been worth 10, 20 times that it was trading for. But we knew that it wasn't as bad as the market thought it was. So,
yeah, I'll chime in and add I've made a note for myself that in the chapter on patient opportunism, the importance of never being put in a position to be a forced seller, as those often are the best buying opportunities when asset holders are forced to sell. And that reminded me of GameStop in 2019 when the company had concluded its strategic review. It had opted to sell its Spring Mobile business. It hired new leadership and was embarking on a new strategy. And it cut its dividend to zero. And at that time, the company was heavily owned by institutional longs and also, of course, some retail longs. But when that dividend was zeroed, any institutional holder whose mandate required that they own dividend yielding stocks was a forced seller. So over the course of 2019, and these are pre-split prices, it of course did a 4-for-1 split in the last year, but the price of the equity ran down from about $16 per share in the beginning of the year, and after the dividend was zeroed, it got all the way down to $3 per share by the time August rolled around. And Michael Burry ended up writing a famous letter to the company encouraging that they accelerate their share buyback authorization they had. His letter noted that they could have bought back 80% of the shares outstanding had they done it in full at that price. So I think prices can get very dislocated in both directions. Clearly, the last couple of years have shown that. And in the GameStop example, it got extraordinarily dislocated to the downside before. I think we can all agree in January 21, it got dislocated in the other direction. So, definitely, that's a big thing, right? Is that's a big learning, I think, from the book, or takeaway that everyone should really be cognizant of, is your best chance to be a buyer is when others are forced to sell. And that example rung true to me. So let's. I know John said, just pinged me. He's going to be joining in a couple minutes here, but I would like him to chime in when he does get on. In line with the second level thinking, like, I think it's a really good mental exercise. If you don't like thinking, investing is not a good exercise for you to be involved in. I think to be a good investor, you have to enjoy giving things a lot of thought, trying to think through all the probabilities, trying to think through what the impacts of X are on Y, and so forth. And I think a big takeaway in that second level thinking, is the truism that I think Marx had a little grid on. I think it's in that chapter, but I guess the quote is, the problem is that extraordinary performance comes only from correct non-consensus forecasts. But non-consensus forecasts are hard to make. They're hard to make correctly, and then they're hard to act on. So to get superior investment results, in Mark's view, you have to have non-consensus views, and they have to be more accurate. So that second level thinking feeds into that to get the investor a step ahead of the crowd, but it's very difficult to be more informed than the market, because the market is a discounting mechanism, and as new information becomes available, it generally does a good job of discounting that new information. I think that the examples of ways to realize a superior insight, Mark, on that second level thinking, I know Marx talks about later in the book, or in one of the later memos, that you can know more. It's unlikely you'll know more about the market at large, and he generally has a pretty negative view toward macro forecasting, but he makes an important caveat that you can get a knowledge advantage in an individual company. The quote I see is, "Try to know the knowable." And to use GameStop as the example, of course, we spent a lot of time in both 20 and 21, leading up to the initial GME DD research reports that were published, in what we knew, that we thought we knew better than other folks in the market. We had crowdsourced order numbers and information. We had people that had poured over some of these these filings, like the letter from Ryan Cohen, his first 13D filing, where he had a famous shareholder activism lawyer as his attorney representing him. These sorts of things that, if you looked really closely, implied that maybe the business wasn't performing as poorly as the market expected, and that perhaps there was an attractive path forward for an activist. And obviously things played out that way, but I guess those are a couple of examples of knowing things maybe that the market might be missing.
Yeah, I'd ask you, Rod. You have much more time in the market than I have. How long do you think it was until you were a second level thinker?
I think it took getting blown up in my teens, during the GFC. I remember thinking I was clever in 2007. I bought a Lehman Brothers bond, $1,000 investment in Lehman Brothers, and that in hindsight just looks stupid, of course, but I think it does take, for a lot of investors, getting kind of having that experience, whether it's blowing up a trading account, or making some poor decisions early on, that help them to realize that it's actually really difficult. There's a reason investing is not considered easy, or those that consider it easy, maybe they're out of the market pretty quickly. The ones who've been around the block for a cycle or two realize how difficult it is, and you kind of learn that humility, whether it's a lived experience or just letting enough time go by trying to absorb the knowledge of those smarter than you. So it took me time for sure, and it took that experience. um, John, it's nice to see you, or digitally see your lovely profile picture. Um,
Everyone.
so we were talking a little bit about the book, and we got a little bit underway. I'm gonna kind of put you on the spot though. So you were the one I think that chose this as our second book, and I would ask you if you could maybe share what led you to choose the most important thing, and maybe in addition to that, share some thoughts on Howard Marks and how his writing has impacted you as an investor.
Sure. I mean, by far, I think this is the book that's impacted me the most, not only as an investor, but as a person. I mean, not only does Howard have the ability to break down a very complex concept in such a simple way, but he covers the idea of risk in such a way that I've never seen described before. And the nice thing about that is when he talks about how to make quality decisions in the face of uncertainty, what exactly do you do? How do you think about it? And that not only goes, to anything that you invest, but every decision that you make in life. So, I mean, we can go into a bit more detail about exactly how he thinks about risk, because I mean, that's basically what the whole book is about. But yeah, the reason I love it is it's impacted me just way beyond investing itself, to the point where I did reach out to him directly, and had the great pleasure of meeting him in person and picking apart some of the ideas in the book. So he is such a great person and a true intellectual, and I think everybody has to learn something from him, especially from the memos that he writes pretty much every maybe 2 or 3 months. I mean, those are a gold mine.
Yeah, and he had a memo come out ironically. We, of course, didn't know this when we rescheduled the call, but he had a memo come out today. John, could you, for folks who might not be as familiar with Howard, maybe just share like an overview summary of who he is, who Oak Tree is, and you mentioned the timing of the memos, but maybe just elaborate a little bit on what he's writing these for.
Sure. So he's always had a habit of writing down all his thoughts directly and then sharing them with the world. Well, his style is basically to always go back to his writings, because so often we forget what our own biases were and then what we were thinking about at that exact moment in time. So that's why he's one of the few people that writes all these memos up all the time to this day, over the course of 30 years. And just to share a little bit about him, he runs Oak Tree Capital, which I believe is, I think it's the biggest bond fund in the world. But he is the pioneer and the guy that made a killing off of distressed bonds in the 80s, when virtually every person on the planet was ignoring them. Um, so yeah, I mean that's his bread and butter, bond investing, and that's what he still does to this day.
Yeah, that's a good summary. It's interesting. He in the memo he had out today. So to your point, I just a quick Google tells us that as of the end of the first quarter, the assets under management for Oak Tree are 164 billion. So quite a significant sum of money that Oak Tree manages, and to the point of he began in what was a sector, a space that was very unloved, this high yield or junk bond sector. In the letter today, he noted that that was one of the first sea changes that he saw in his career. Um, the willingness of investors to prudently buy bonds of any quality as long as they were adequately compensated for the attendant risk, is the quote in his letter today. And he noted that when he got started, it was only $2 billion for the entire high yield bond universe. and today it's roughly 1.2 trillion. So pretty incredible how much the high yield bond space has grown since he initially got involved in the late 70s. And you're right, when he got involved, it was not a space people were interested in investing in. Some people, goes back to, if people are unwilling to buy a certain class of security, then that should inherently lead to opportunities. If people, due to their mandate or due to whatever, are predisposed not to invest in a certain, whether it's a sector or asset class, then that asset class or sector may offer the opportunity for alpha if there's fewer eyeballs on it. And intuitively, I think we can probably kind of come to that conclusion in line with what Howard would say. But risk, as you said, I think, John, is the like overarching theme around the book. And there's a great visual in the book, in the understanding risk chapter, and it shows kind of that, that security market line concept, that as risk increases, the investor demands higher returns. But he, in that figure, and Joe, let me see if I can find a way to, I guess, tweet that image so we can pin it, because it's a great visualization of
it's funny.
risk versus return.
When I met with him, he said if there's one single contribution that he's made in finance that is actually worth something, I mean that's what it is. And it's funny because none of the academics explain it this way, which I don't quite understand.
Yeah, I know we're talking about visuals, and I'm going to try to add this visual so that we can kind of hopefully all understand what we're talking about. The line, I guess, is, if you look at just the line, it's static, but what Marx adds that is profound is the idea that the probability distribution, the range of outcomes in a higher risk investment is likely to be larger than the range of outcomes in, a treasury bill. If you buy a government treasury bill, you're pretty much guaranteed you're going to get your money back on the lowest end of the risk spectrum. And as you march up the spectrum, of course, the range of outcomes, whether it be a credit product and the chance of default, or if it's an equity and the chance of, say, bankruptcy on the downside, but of course the upside becomes far greater. But yeah, that's great, Joe, to hear that, that's what he shared with you in private.
No, yeah, I'd say, like this might seem obvious when you put it into words, but if you look at the way that they teach this in school, there will literally be a perpendicular. I mean, there'll be a graph with the line that you just mentioned, right? The more risk you take, the more returns you're gonna get, and then that's it. It's a linear diagonal line, which for me always begs the question: how does that make sense? I mean, if you take more risk and get more return, then why don't you just take more risk, right? So it is a bit paradoxical if you don't actually explain the nuances of what that mean. And then to your point, to your point, he actually drew vertical lines around each plot point on that graph to demonstrate that the variance is going to be extremely high. The dots you actually see are the expected values. So on average, over time, in theory, the more risk you take, yeah, your return should be higher in theory. And that's probably best exemplified by the stock market. I mean, averages 10% a year since its inception, more or take, even though the variance around it might be far, far greater than a treasury bill, like you mentioned. So, yeah, he's very proud about that particular page.
Yeah, I just pinned it so people in the spaces can see that visualization. I just tweeted it out rather and pinned a tweet of the visual. But yeah, that's definitely vitally important, that those ranges of outcomes, if you're just looking at the point on the line that represents the average, that midpoint doesn't represent the reality that you are bearing some meaningful incremental risk as you move up that spectrum. One of the really key concepts that Howard talks about throughout the book is the idea that risk is not higher volatility. And a lot of our mainstream like financial thinking and even things like how to compare, one investment fund from another with like say a Sharpe ratio, that incorporates volatility as a proxy for risk. But Howard's very adamant that volatility is not risk in of itself. Um, he
Agreed.
Yeah, and he points out some other types of risks that are not market risk, but like personal risks. For example, if one has a target investment return and they fall short of it, if one
Right.
underperforms, if there's illiquidity, if they are acting unconventionally, like those are all different risks. And lastly, before I let you chime in, John, there's a quote that there's a big difference between probability and outcome. Probable things fail to happen, and improbable things happen all the time. And that's one of the most important things that you can know about investment risk in Howard's view.
Yep. Yep. And then just to go back to your point about the mistake of conflating volatility with risk, right? I I actually blame that concept entirely to the academics. So when they choose a discount rate, they use something called the CAPM model, right? And then one of the biggest variables in that equation is beta, which is a historical measure of how volatile that stock or asset was relative to the entire market. Um, and I think academics have this entire idea that they have to quantify risk when it just is not possible, uh, and that's how the whole story of how volatility became a measure of risk. And I think that's a big mistake that you can make. The biggest risk is something that the biggest risk is buying something that's not worth what you're paying. I mean, I think it's that simple.
That's definitely a recurring theme throughout the book, the idea that the easiest way to minimize risk is not to overpay. And that's all built on the need to conduct some level of analysis on the underlying company or security to get comfortable with what you, the enterprising investor, can think that the intrinsic value of that business is. And if you're paying more than the intrinsic value, then you need a whole lot to go right for you. And whereas if you inherently are paying meaningfully less, then that that basic truth that under underpaying reduces your risk, or paying less than something's worth reduces your risk, whereas paying more than it's worth increases your risk, I think is a vital point that's prevalent throughout the book that like you just can't repeat enough. And I'll quote Howard in the chapter on recognizing risk. He says, "The riskiest things, the greatest risk doesn't come from low quality or high volatility. It comes from paying prices that are too high. This isn't a theoretical risk, it's very real." And that investment risk comes primarily from too high prices. And we can explore some of the discussion on the psychological, which is, of course, another major theme of the book, that those high prices often are a byproduct of excessive optimism, inadequate skepticism, lack of risk aversion. I think another key when it comes to the risk discussion is that Howard notes in the controlling risk that only a skilled and sophisticated observer can look at a portfolio in good times and divine whether it is a low risk portfolio or a high risk portfolio. If we were to all put our our stumbling over the words, if we were to all go back in time a year, 2 years, and take a look at portfolios that have been performing exceptionally well in the short run, those portfolios that were loaded with technology companies, that were loaded with a lot of maybe de-SPAC companies, those portfolios that have just performed or been performing quite well, those were probably some of the highest risk portfolios, although it wasn't obvious maybe at the time. And I think Howard is a credit-oriented guy, so his thinking is often in the lens of that number one rule that Warren Buffett is famous for. Rule number one: don't lose money. Rule number two: don't forget rule number one. That controlling risk is obviously vital, and you're not always going to realize or recognize that you've effectively controlled risk, because the loss that you don't incur is risk management and risk mitigation. But it's really hard to see that in the moment, that maybe the investment you didn't make into Carvana was actually the best risk management that one could have undertaken, so to speak.
Yeah, one takeaway I noted, specific quote actually, was people should like something less when its price rises, but in investing they often like it more. And I think you see that a lot in retail investing, even just running like a Discord server with thousands of people in it. Once the price of an equity rises rapidly, people suddenly want to get a channel dedicated to talking about it, and they want to like know more about it. And it's like, this is the point where you should be considering exiting and people are suddenly wanting to hop in. So that's something you really do see a lot in retail.
Kind of go off that. I think the issue is that people think the risk increases in the recession and falls in booms. So I'm quoting Howard Marks here. So the main issue is that it's really hard to understand when the risk is increasing and risk is falling. But what's happening now is that we've seen risk skyrocket with the unprecedented boom market, and now we're seeing everything kind of crashing down. But how people think of risk is quite the opposite. People think that risk is going up because of the market volatility we see and because the market's crashing now. So this brings us back to the question, in today's market, how do we identify companies and how do we make sure that we pay less to create the margin of safety and minimize risk and maximize return, as Howard puts it here?
Yeah, Han, in line with that, there's the quote from Templeton about the importance of, in the section on the importance of contrarian thinking, the quote is, "To buy when others are despondently selling and to sell when others are euphorically buying takes the greatest courage but provides the greatest profits." And I agree with what Joe had to say, that I've seen it as well, whether it's a StockTwits channel, whether it's Twitter cash tags, whether it's the GME Discord, or anywhere else, the discussions, you see it firsthand when people are actually the most excited about a security is oftentimes when that security has just experienced a massive run up in price and is perhaps the least attractive from a forward risk perspective than it may have ever been.
Yes, it's very counterintuitive. That's why psychology is such a big part of the game, right? Because it's essentially the same thing as being more excited to purchase a TV from the store because it got more expensive versus a discount. But yeah, that's why it's so hard. And I think we can all say even though we know these things, we often fall into this victim of this type of thinking.
Yeah, I'll admit it and fess up to it. I fell into that thinking in late last year with the crypto space that I had successfully avoided for my investing career until the fourth quarter of 2021. And those emotions that Marx lays out, greed, fear, FOMO, envy, right? We all saw throughout 2020 and 2021 until they stopped going up, that kind of unmitigated rise of a lot of these cryptocurrencies and tokens and NFTs, right? Which isn't to say that all of them are worthless, but it certainly was very manic, and I know I fell victim to that, fallacy, that greediness, and got involved and certainly lost a lot of money with hindsight. So none of us are immune to it, and it's not in the book, but I think one of the best examples of this would be Sir Isaac Newton, who got wrapped up in the South Seas bubble and basically lost his life savings on the downside of it. He made some money, he got out, and then he FOMO'd back in. And Isaac Newton is a hell of a lot smarter than I think all of us on the call. And if he's susceptible to those psychological factors, I think we should all recognize that every one of us is human, and we are also susceptible to them.
Right. I remember as you were kind of getting slowly pulled into the crypto world, late last year and early this year, and that's the really hard part, right? How do we keep ourselves balanced and how we keep our minds straight while the entire world is talking about this one thing that seemingly is going to go up forever? So how do we keep that discipline? I think that brings us back to the reason why we're having this call to read these books like this together and talk about it so that we can all keep ourselves disciplined.
Yeah, I'll kind of run through some of the in the combating negative influences section. Greed can lead to unrealistic expectations and ignorance of risks. I think everyone, by and large, was trying to make as much money as they could, right, in 2020 and 2021, and I think that led to a lot of ignorance of the realities that if you're buying something that's maybe you're buying it on a price to sales multiple, and you're not even doing the analysis of what the unit level economics are of that business, and what would a steady state fully mature version of that business look like, and when you consider like what has to go right for there to be upside from the level that one might be buying at, and there was too much thinking of the upside and not enough thinking of the downside. The line in the book is the willing suspension of disbelief that these things will continue on forever and that there's some new paradigm. And in the book, of course, Howard's talking in a lot of his examples about the great financial crisis or the dot-com boom and bust, and there are definitely corollaries that carry over. And I think the crypto boom and subsequent, I guess we're amid the bust, who knows where the bottom for that is, it is very much in line.
Yeah, one quote from Howard Marks: one way to improve investment results, which we try to apply at Oaktree, is to think about what today's mistake might be and to try to avoid it. And I think for last year and early this year, it's easy to see that it was crypto and the boom and just the arrogance that it was going to revolutionize finance immediately. And obviously it didn't end up happening, and it's in a bear market right now. But I mean that's very easy to say that what today's mistake could be. And for me, I did see kind of crypto. I thought it was rather high price, as if it was already an important part of finance when it was yet to be.
I think that the section in that kind of discussion on the psychological, the reality is we can't become robots as much as we may want to be, but Howard talks about ways to guard against those emotional negative influences. And it goes back to the importance of having that strongly held sense of intrinsic value, and that you should insist on acting as you should when price diverges from value. And that holds true in both directions. If price runs far ahead of value, then just because you think other people may continue to bid it up, you're actually acting irrationally. If your view is that the intrinsic value is X and the price is now X plus Y, well, why are you still holding on to that investment? And And then we get all of these different things like sunk cost fallacies, and we don't want to sell too early because maybe we saw that happen to us in a different security, and it's really difficult. I mean, we're having this conversation, and it can't be understated how I think looked at you need to have that fundamental kind of foundation for what makes you think something is worth what you believe it is. You should have the historical reference to understand that when there are excesses, those don't get rewarded when they reach their extremes. They get punished, and crypto being the more proximate example. Thinking about profitless technology companies, you think about, not to drag Kathy Wood too hard, but her prognostication that we're going to see, what did she say? Like gross domestic product would be growing at 50% year over year in short order because of all of these incredible changes and new technologies that are coming. And I guess it's conceivable, right, that those things could happen, but that sort of like excessive tail positive outcome, you shouldn't be banking on that. You need to have a margin of safety, or you should be investing with a margin of safety. So how does one come up with the intrinsic value of an idea that hasn't generated money and might not generate money for many years to come? It's really hard.
Hey guys, can you hear me?
Hey Dean.
Perfect. So first of all, I hope everyone's having a great evening, and thank you for allowing me to be a speaker. A question I had was how to tell if a stock or even an investment in general is overpriced.
So I'll give you the simple and book-driven answer. You should have an independent assessment of what it's worth, what its intrinsic value is, and logically, if it's trading in excess of your assessment of intrinsic value, then it's overpriced. And even similarly, in line with that, and I'll let the other speakers comment, would be if it's in line with your estimate of fair value, well then there's no alpha to be had, or there's no outsized forward return to be realized through that investment. It would only be if there's a discount to your estimate of intrinsic value. And I'll pause there and let others chime in.
Well, I just say that you can never tell for sure, right? Hey, is this overvalued or not? Because if there's a certain answer, then, well, everybody would make money in that case, right? But it's situation specific, but there's various different types of metrics you can use. I mean, depending on the company, you can model it out. You can compare it to other companies in the industry. But mainly it comes down to the work that you've done on the company to formulate those types of answers, even when you make those quantitative judgments. But the goal, in my opinion, isn't to actually determine whether something's overvalued, but whether, in the face of uncertainty, it seems overvalued to the point that even if you're wrong, again, we go back to the point of margin of safety, that that your investment is still going to turn out all right. The goal is to be more right than wrong, as most people would say.
I think to be more right than wrong, Howard Marks, lists some of the things that we can do. First thing is having a strongly held sense of intrinsic value. And there are also things like willingness to look wrong while the market goes from misvalued to more misvalued. So, essentially, as John said, there is no way to be sure if a certain company is overvalued, but it's all about, being more right about more companies than others. And there are things we can do to hone our skill sets and make sure that we have a good sense of market psychology and the intrinsic value of the company that will help us in the long run.
Thank you very much.
Yeah, thanks, Dean. And you're welcome to stay up and keep chiming in as you desire. And this holds true for anyone else who's listening in the audience. If you want to put your hand up and chime in at any point, please feel free to. It's not intended to just be a intra-Wook conversation. To kind of, I guess, build on what Han was just saying, though, that willingness to look wrong, it's really easier said than done. And one of the last points that Howard raises is the importance of having like-minded friends and colleagues from whom to gain support. I know I've shared this story, my personal story, when I felt like I was very wrong, or at least the market was telling me I was very wrong. When I thought GameStop was misvalued and it seemed to get more misvalued, I started seeking out, trying to understand what different people's perspectives were. In like 2018, I started perusing stock twits and seeking alpha, and trying to talk to different people and finding people who maybe were also invested in what their thinking was, and of course seeking out people who were negative and what their thinking was. And it goes without saying, right, that we never know these things with certainty in the moment, but you're trying to get trying to guard against that despondence when it keeps getting more and more misvalued. That's a way to do it.
I'd like to piggyback off of the overpricing, if it's fairly valued or not, and looking at the intrinsic value. One thing that I found to be interesting is on chapter 11, it's not just only about if the stock is priced incorrectly. If you determine if it's cheap based off of the candidates of investments that you're looking at. So although this may be better priced compared to the intrinsic value, that shouldn't justify the purchase. You should be comparing with other stocks and trying to get the best bargain for it. So I thought that was a little bit interesting.
Yeah, I think in line with that, JP, the finding bargains chapter kind of talks about that for sure, where you need to have, to find these bargains, you need to have a list of the potential investments, and some might not make your list for whatever criteria, whether you are limiting your scope to certain sized companies or certain geographies, right? You might exclude certain investments. So it ends up being a comparative exercise, because you're going to compare and contrast those like investments and try to find what the relative best investment option of those is. And then the chapter kind of further discusses good places to start for finding those underpriced assets are ones that are little known and not fully understood, ones that fundamentally seem questionable on their surface, ones that are controversial or frightening for some reason. They're deemed inappropriate for respectable portfolios. They're unappreciated, unpopular, and unloved. And they have a trailing record of maybe poor earnings or poor returns, and they've recently been getting sold off rather than bought. That preceding point about unappreciated, unloved, unpopular, I know Mike Burry, he kind of summarizes his investment approach that buy the roadkill, and then after it's been shined up a little bit, sell it. And it's obviously not within Howard's book, but I think it's very much in line with that if you're buying something that's viewed as trash and priced as trash, and if you discern through your variant perception and your second order thinking that first take is perhaps not right, then that should give you a good opportunity.
Yeah, it also comes down to just like taking those gains when you get them. If you bought a company that was priced as if it was terrible, and suddenly it's priced as if it's, a little bit not so bad, it might be a good point to get out. Even if you think it's a great company, it has been a huge shift in sentiment already, and got to kind of take those wins when you get them.
I think another really good point to really bear in mind, especially thinking about this market environment is obviously very different than 21 and 20, but in those very manic market periods, it was trying to find the greatest thing and trying not to miss it, and the patient opportunism, most important thing memo. There's no reason that people need to feel that like insane. There shouldn't be that rush to swing the bat, right? With Buffett's story, kind of talking about baseball analogy. There's no penalty in investing except for the opportunity cost if you don't swing. You don't have you're not in, it's not a game of baseball where you're in the batter's box and you're going to get called out if you don't swing. And in investing, you may forsake gains if you omit good investments. You certainly forsake losses if you omit bad investments, but not swinging means you're going to get whatever your return on cash is, which, let's be honest, the return on cash today versus a year ago is meaningfully changed. When you had a Fed funds rate at a 0.25% versus now, after tomorrow it'll likely be north of 4%. So that 4% is a meaningful difference now that you should kind of have as part of your thinking, and you should be patient, and you shouldn't feel the need to chase and jump into things. In that same chapter, Joel Greenblatt, another incredible investor, noted that for Gotham, for his fund, we may look through 50 or 70 investments to find a handful of good ones. If we buy 6 that work out and miss 15 that we should have bought, we never view this as a loss. So I guess I would ask, how do you avoid maybe that urge to chase or to jump into something and embrace that patient opportunism that Marx kind of preaches in that memo?
I think the most important thing here is to really bring the to understand the market psychology and to pay attention to what the market perception is versus the reality. Actually, my favorite quote from this book is that investment is the discipline of relative selection. So, investment really boils down to making better decisions and being more right than other people. This theme has been echoed throughout our conversation today. And really the only way to do it is to have a keen sense of what the market perception is saying and keep monitoring that, so that whenever there is that discrepancy between the market perception and the reality, then you can act on it with conviction and stay wrong while the market perception and the reality converges eventually. So it's obviously it's easier said than done. We're all here trying to do the same thing, but keeping in our mind that the investment is the discipline of relative selection. This idea really helps me to gain more conviction in my decisions and keep monitoring what the market perception is.
Yeah, I really liked, Han, that exercise in the having a sense for where we stand section, where there's this checklist that Howard lays out around the economy, around the outlook, lenders, capital markets, capital, and he has these binary responses. I think one of the contributors notes maybe to respond to these on the spectrum, but you have, is the economy vibrant? Is the outlook positive? Are lenders eager? Are capital markets loose? Is capital plentiful? Are the terms easy? Are interest rates low? All of the characterizations of 2020 and 2021, these are times where the investor should be cognizant of that the market is perhaps not appropriately pricing risk into its thinking, that it's maybe gotten drunk on hope and thinking that things will go on in the good way forever. He talks about these items in the checklist. Really, you should kind of be taking this pulse check on a regular basis. Is there ease of capital access? How do earnings ratios look? are yield spreads, is there a big premium priced in relative to treasuries, or is it narrow? Overall optimism. Are there a lot of securities offerings? Of course, there were a ton of those in 20 and 21, and we have the benefit of hindsight that, it was so obvious that things got a little overextended, right? But I think taking that pulse check of where things sit in the cycle, Marx is very clear as to say he doesn't know where things are going to go, at least not on any particular time horizon. But when the pendulum moves too far in one direction, eventually it always will swing back. And while, again, it's not a precise measure of when it will swing back, it's kind of gauging based on some of those different items in that checklist I was articulating. Again, that's in the having the sense for where we stand, which is chapter 15, that getting that feel right. The word feel is dangerous to use, but it inherently is a subjective analysis, right? You can look at objective measures like those yield spreads and those earnings ratios, but when you tie it all together, it has some it's not an objective thing. But that's so important to really get a sense for where things are. In his memo out today, he notes this sea change that he sees happening, this third one, where the quote from his memo today is, "For what I felt like eons from October 2012 to February 2020, my standard presentation was titled Investing in a Low Return World because that's what our circumstances were." And he basically notes that was then, and this is now. And now, as interest rates are no longer at zero, he kind of lays out the difference between from 2009 to 2021. You had a highly stimulative Fed, you had dormant inflation, a positive economic outlook, minimal likelihood of distress, an optimistic mood, eager buyers, complacent holders, etc. Whereas that has shifted today, where we have now tightening environment, inflation at a 40-year high, recession is seen as likely. So all of those things might tell us that the pendulum swung, certainly, back from the extreme it reached in 21. Where is it today?
Yeah, the only thing I would add, that doesn't mean you should just try to go out there and answer these questions and then try to time the market based on what you think the answers are. But sometimes those answers are clearer than other times. And even then, that the best you can do is maybe allocate your portfolio differently, perhaps in a more defensive position. So yeah, I just want to say he's not advocating that you should time the market, but it is possible to have a slightly better understanding of the probabilities that are more likely in the future, and then adjust your portfolio accordingly.
For sure. Yeah, I think that in essence, it's a marginal step that he certainly isn't one that says to time markets like you said, John. But if you recognize the characteristics of excessive fear, et cetera, then maybe you need to overweight your equities allocation or whatever your risk taking appetite is. Maybe in Howard's case, it might be buying more distressed credit. Whereas, yeah, if your perception is that things have gotten really extreme, which he's clear, it doesn't have, things aren't always at the extremes, right? They reach the extremes every so often, and the investor who's trying to be enterprising and realize alpha is certainly not living in a vacuum. He or she should be paying attention, even if they're not prognosticating about the future. They should at least have a sense for where things stand today, and allow that to inform their allocation decisions. Because Howard's definitely clear he does not think that forecasts are very helpful. And I think it's hard to argue over what we've seen over the last few years, how many of these economic forecasts at the macroeconomic level have borne out. Few. And if they do, I'm sure that forecaster ended up wrong on the next step, or many others, right? And at the macro level, his view is that forecasts are of little value. But again, that gets back to what we talked about earlier, that you can achieve a variant perception on individual securities or companies based on knowledge you accumulate, those nuggets of knowledge that we've talked about in the past. So, okay, just to kind of recap, it's 8:08. We've been going for about an hour. My plan is to let this run till 9 or until we otherwise exhaust the conversation. But we introduced the book a little bit, Oaktree, kind of talked about some of the main takeaways, talked about risk a bit. We've talked about these psychological influences and cycles. One thing we haven't really talked much about is the role of chance. And I'll share a personal story on that one before inviting others to remark on randomness. I mean, it's so difficult, I think, and Howard makes the point throughout the memo was that just looking at an investor's results, unless you have maybe many decades to go by, but looking at results without looking at the process, you really need to look at the process to discern who is or isn't maybe a good investor and who hasn't otherwise been impacted by the random stroke of luck. I mean, going back to the GameStop example, I felt like I knew more than others about the security, going back to that point of achieving some level of variant perception in fourth quarter of 20. I had been tracking order numbers through crowdsourced research. People were sharing their e-commerce order numbers. I'd uncovered that they were sequential, and you could gauge how their performance was going and kind of model out how things were going for them. And I had concluded that their holiday sales results were going to be quite weak. And so I had leverage on it at that time that I took off call options. And while the holiday sales results ended up coming in very weak, I had no way of knowing that in tandem with them reporting those holiday sales results in early January of 21, the company would also report a settlement with Ryan Cohen, with him naming 3 members to the board. And that random stroke of chance, in my case, meant forsaking multiples of my realized gains after the entire thing shook out, because I had taken off my leverage, because I'd made the right decision based on the known information, but the outcome was negative for me. So I think about that one a lot. And John, I know you've remarked on that one, and it just really speaks to you can know everything, and you can think you know everything, at least, and even then, chance is inescapable.
Exactly. So the way that he puts it is, well, he told me that most people think of the future too much of a binary perspective, right? So is this investment going to work out? Is this overvalued or is it not overvalued? Um, but he says that's the wrong way to think about it. All he thinks about is, hey, what are the probabilities and the outcomes associated, and the expected value that you can kind of calculate based on that, and based on the price that you pay, and if there's a significant enough delta, then you should make a decision. But he says that he never actually spends any time thinking about, oh, am I going to be a right or not? It's the question is, hey, is this a good bet? And sometimes good bets go wrong too, and that's fine.
In a similar vein, wanted to bring up that so Howard says that at Oaktree, they believe firmly that if we avoid the losers, the winners will take care of themselves. So echoing what John said about how how Howard doesn't pay too much attention about what the exact winners are going to be, but as he explains in the book, if we focus on avoiding the bad, the losers of the market, kind of he also uses the tennis game example as well, that we as amateur players playing against the professional tennis players, we should focus on defending ourselves and making sure that we don't hit any losers. So I think it's important to focus on defending our portfolio and putting more time and effort into making sure that we avoid those losers than to just focus on winners, which will likely which will push us toward kind of in that following that manic trend and ignoring that market perception.
there's the Buffett quote in there that, quote, an investor needs do very few things right as long as he avoids big mistakes. So in that kind of avoiding pitfalls memo, just to build on that idea that the main pitfalls that Howard sees are succumbing to those psychological forces, greed and ego and other. Look, I mean, very very candid for me. I have discussed securities that when you discuss it publicly, it inherently has that ego effect, and you need to be very conscious. Are you still believing that this security has a discount to its intrinsic value because of your objective analysis, or because you have sunk cost of the time you've put into it, the positive remarks you've made publicly about it, etc. That's a real pitfall. He notes the error of not noticing and of omission as some other pitfalls for investors to avoid, to try and ensure they don't make those big mistakes. It's very difficult. And I'll bring up the second to last memo in the book, is the importance of having the right expectations. It's reasonable expectations is the phrasing that Howard uses, and in line with what we were saying just before about from his memo today, that in 2009 to 2021 it was a very low rate, highly stimulative environment, that the expected return profile should inherently be lower, and basically you need to go into it making an investment with the right expectations. Like John said earlier on, if you look back over the last century, the average return is around 10% per year. It can of course vary meaningfully over long durations of time, but if you're targeting something like 20% annual return, you're immediately setting yourself up for failure, because now you're going to be needing to take on very high risk, and that risk may be out of line with what with protecting your downside and trying to minimize those big losses. So you could be setting yourself up for failure. And he specifically notes that those excess high returns are unnatural, and they require the starting point to have been an extremely depressed environment or extraordinary investing skill, which it's hard to know in the moment, or you're taking extensive risk, leverage, or getting very lucky. And those latter ones aren't sustainable, and they're setting you up for failure in a down period. I think it was interesting in that chapter, there's some discussion on the Bernie Madoff scandal. And that kind of goes hand in hand with both the arrest of Sam Bankman-Fried and the collapse of FTX and some of these other crypto exchanges that have collapsed, and like where Madoff offered team guaranteed returns over decades in any environment, and it turned out to be a Ponzi scheme. The discerning investor should raise an eyebrow and very much find that as a cautionary tale, right? Both these crypto scandals and the Madoff story, that anytime you're seeing these promises of outsized returns, there's some risk that you're probably not recognizing, or that's being maybe papered over. And if those outsized returns were available to all market participants, then why aren't they taking them? And there's probably a reason. There's probably a risk that you're not identifying when those are getting dangled in front of you.
Yeah, I was reading today actually about SPF's um, being arrested, and there were some different theories. I was wondering why it took so long. I think a lot of people were wondering why it took so long, but there were some different theories that because he's talking so much and he just kept implicating himself, the Department of Justice kind of let him keep doing his thing, knowing that the day he steps foot on U.S. soil, they'd be ready to arrest him. But it definitely required more care to have an arrest in the Bahamas versus on U.S. soil. So that was just interesting to me, and I'm curious if you'll end up speaking at the committee hearing.
Yeah, probably not. I imagine now that he's been formally arrested, that things will have less communication from him. Okay, but again, we've kind of gone through some of these major themes. I want to encourage anyone who's in the audience who has any questions or who'd like to chime in, maybe harp on something we haven't delved into, to feel free to raise their hand and come up as a speaker. We certainly don't bite.
Rod, I will ask before while we wait for anyone to come up and speak, I was just curious, what was your main takeaway? What was your biggest takeaway from the book? There's, I mean, obviously so many different themes, so many little lessons, but if you had to sum it up in one or two sentences, what would you say?
Investing is really hard. You can do a lot of work, and you can still realize the wrong outcomes over a short period of time. And it 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 takes some mental fortitude to, and I think a good support system, and hopefully whether you opt to kind of become part of our investment community with Wook, or seek out others who are willing to question things and try not to just chase the quick buck. Because again, there's nothing wrong with trading, but if you're truly thinking of these things from an investor perspective, you're inherently going to find yourself wrong many times, and sometimes you will. It's easy to conflate the outcomes with what went into it, so it requires a lot of that, I think, intellectual honesty with yourself. Um, and I think just really trying to step back too and recognize that if you make the right decisions over a long period of time, on net, you're going to get the right or the desired outcome. But that on that journey, it's hard to see a one-for-one relationship with the right decisions and the results you want to see, and to not get discouraged over short periods of time necessarily.
So I think there we had a pretty lengthy and good discussion about the content of the book, but I want to switch gears a little bit and ask John about meeting Howard. So for context, John got a chance to meet Howard personally a few months back, and John, can you tell us something about how he was like in person? How the meeting went, how you felt, what you learned, etc.
I was actually pretty nervous going in at first, but he is a very stand-up guy. And I'd say that if he wasn't in finance, he probably would have become a professor somewhere like at a university. And then he just happened to stumble upon finance and happened to make him a lot of money through his passion through it. Such a his learning process is unmatched. And I was talking to him, and he would literally go into the room and bring out a piece of paper to draw out certain things himself to explain these concepts to me, which I really appreciated. But he has such a logical and academic approach to learning, but also knows how to balance it in a way that that is actually applicable into the real world. Very nice guy. I think he could tell that I actually read most of his writings. So yeah, I mean, he invited me back. So I guess he kind of likes me.
That's great. So I recall, since it was clear that you've read all of his writing, and when you guys met in person, you guys kind of, took a dive right into the theoretical stuff, and talked about like his, kind of like technical details. Can you explain a little bit about, kind of the main summary or takeaways from what was discussed when you guys met? And is there anything, and if there is anything new that came out of this conversation?
Honestly, when it came to finance, he's already written about them all, so there's nothing new he actually told me about. Um, but he did tell me he's writing a new book because I think he's almost done with writing memos in finance, and he himself finds it a bit repetitive when he writes these memos. If you think about it, for 30 years, he can only write about risk so many times, right? So I think his upcoming book is on life, just his approach to life, general life lessons, which is which I'd be very very interested to read. I wonder when that's coming out though.
I
We're
see we
going to get
brought
a
up
Howard
Jimmy
version of
here,
Richer, Wiser, Happier.
but we brought up Jimmy here. He's got his hands up. We'll let him speak.
Guys, I'm on my AirPods, so I hope you can hear me okay and that I don't cut in and out.
Yeah.
Good? Okay, awesome. I think something that you said, Rod, earlier, I wanted to riff on. You were talking about chance, inputs and outputs, and it got me thinking. I listened to a great conversation today, and one of the questions that was asked was, what is the most amount of due diligence you've ever done on a company that you then decided not to invest in? And it got me thinking because, especially retail investors, but even hedge fund managers, our time is limited. And so much of the time when we start doing due diligence, we start going down a rabbit hole, we got our intellectual credentials. We tend to mentally price ourselves in and think that, an investment is owed to us or a position in our portfolio is owed to us because of that. And, hearing about your story with GameStop, Annie Duke's got a great book called How to Decide, and she talks about resulting, where a lot of the time when we don't reflect on our process and the inputs that go to the output, we tend to look in the rearview mirror and decide on the quality of our judgments based on the performance or based on how things turned out, right? And a lot of the times there's no way to back test, but even when it comes to making trades or making specific investments, if we're not honest with ourselves about the context in which we entered into a decision, we're the easiest to fool. It can result in a series of really bad takeaways, and and that's how blowups happen. People get overconfident. They look back to a previous decision they made and they saw how well it worked. I mean, I think you can all attest that the COVID period, even the late 18-19 period, there were so many companies that did very, very well. And I know I was full of myself. I probably still am full of myself. But, when I look back on that time frame and think about what I actually learned, I didn't learn a goddamn thing. We learn when we lose money. That's the hardest teacher. But if we're capable of self-reflection and applying some of those things, that could serve us better going forward. So I still think you made the right call on GameStop, right? You gave up a lot of realized game potential, but I think your process was spot on. And if you could do that 9 times out of 10 or 10 times out of 10, you'd be right most of the time.
Yeah, you're not gonna fold pocket aces just because you think that somebody else might outdraw you in the flop, the turn, the river, etc. To draw the corollary with poker. And obviously, poker, it's a lot easier to go back and look at what transpired and gauge if you made the right decisions. You're right; it's really difficult. It really requires that honesty with yourself, and whether you're taking notes in a journal, or you're having ongoing conversations in a Discord channel or in a chat in some social media platform. Like, I think those are all good prospective ways for retail investors to try not fooling themselves into thinking that they know everything and that you should conflate outcome with good decision making, because clearly that it's not always one for one, as you said. But thank you, Jimmy, for sharing that.
And one last corollary. So I think over the last month or so, I've been trying to get myself more into the mind of Gen Z and people who are active in the crypto and NFT space. Now, I think, the results speak for themselves. A lot of people have been completely wiped out. There's no liquidity in their projects or in what they've quote unquote invested in. And yet, it's, I sound like the boomer, right? When I was young, I didn't listen to people older than me. I thought it was a new paradigm. The older people have nothing to offer, but I see the same mentality where people refuse to learn about risk, refuse to acknowledge the risks that are inherent. They're drawn by this, idea of a Web3, of a new way of thinking. And I guess it makes me sad, but I also empathize, and I see where they're coming from. I don't take pleasure in some of these blow ups, but it's the bottom's nowhere near. That there's still there's a lot of lessons to be learned still.
So if we ask Jimmy where the pendulum is from excessive risk taking to excessive pessimism, you still think we're closer to the excessive risk taking side of the spectrum?
Yeah, I think we're closer to the end of the beginning than the beginning of the end.
Yeah. Thanks, Jimmy, for chiming in. Steve, I just brought you up. Feel free to chime in. You're on mute, by the way. Stevie Capital, if you want to unmute yourself, feel free to go ahead.
Yeah, can you hear me?
Yep.
Yeah, okay, yeah. Thanks for hosting this. I don't know. I just caught waiting. I don't know if you guys talk about the memo that he published. He released it today. I don't know what you guys' thoughts are. I don't know. You guys talked about it earlier.
Yeah, we talked about it a little bit. I did read it earlier today. I think it's hard to argue with Howard's perspective that there is a sea change that's occurred from where things stood post great financial crisis, through to last year, or really at the beginning of this year when the Fed kind of changed its strategy. It's hard to see that I think Howard puts it that that there won't be a massive decline in rates by thousands of basis points, right? That the lower bound is closer to us than that. So he articulates that view that the base rate likely to average 2 to 4%, which the Fed funds rate today is toward the higher end of that, but that's obviously very different than 0 to 2. I'm inclined to think that he's more right. It does seem like many folks in the marketplace, are still of the view that the Fed will rapidly return to a zero interest rate or close to it policy. And I think that the Fed has tried to ensure market participants are not of that view, but perhaps they've just been trained over the last decade and a half to hold that viewpoint. So maybe they can't wholly be faulted. But I'm more in line with Howard's thinking that I don't think rates rapidly return toward zero, given some of the things he points out about this shift away from globalization. Last Friday in our Wook Review series that we host weekly, we talked about nearshoring and onshoring and reshoring, and kind of those strategic themes don't seem like they're going to be going away. And those strategic themes are inherently inflationary. If you are shifting away from the lowest cost market and instead to higher cost points of production to build resiliency into your supply chain at the expense perhaps of lowest price. And those things are inherently not deflationary like the long running trend of globalization was. So it still, like, even if we got the CPI this morning that came in a little lighter than some folks expected, and the chairman's been pretty clear he doesn't want to be Arthur Burns 2.0. He doesn't want to claim victory over inflation just to see it resurge in, say, 2024. And we'll see what happens. But I think I'm more in line with Howard's thinking around the environment being different. And yeah, I'll let others chime in if they've had a chance to read the memo.
Yeah, Han asked that I throw up the Poor Man's Guide to Market Assessment. It is on page 131. So we have a photo here of it thrown up on the nest, as it's called. It's featured at the top of the space. Han, maybe you can say what you thought of the assessment, maybe if you participated in it and filled it out, and what your results were.
Sure. So I think this is kind of provides a visual guide, very very easy to understand. What we can think about. When we think about the markets and our future investments. So, and what it means to be a good investor versus, I guess, a more professional investor versus an amateur one. So. I'm not sure if everyone can look at the picture now. As Joe said, it was just thrown on the top of the spaces here. But what Howard does is he lists a number of market characteristics, and he kind of shows kind of the opposing two words that are opposing in each category, such as the economy, the outlook, lenders, capital markets, and so on. So. I can't think of a specific example where this guided me personally in making my investment decisions yet, but I think this is a great guideline to have, a great toolkit for us to be cognizant of as we dive in more into the markets and as we navigate it together.
And I'll just kind of going back to what Steve was asking, around Howard's memo from today, that if you agree with the thinking that the likelihood that we return to a zero interest rate environment is lower now for the reasons of different inflationary pressures existing that maybe were deflationary over the preceding decades, that what it kind of boils down to from the last couple lines in the memo is that there is an alternative now, and that there will be alternatives to equities for investors, given that the quote is, "We've gone from the low return world of 2009 to 21 to a full return world, and it may become more so in the near term. Investors can now potentially get solid returns from credit instruments, meaning they no longer have to rely as heavily on riskier investments to achieve their overall return targets. Lenders and bargain hunters face much better prospects in this changed environment than they did in 09 to 21. And importantly, if you grant that the environment is and may continue to be very different from what it was over the last 13 years and most of the last 40 years, it should follow that the investment strategies that worked best over those periods may not be the ones that outperform in the years ahead." So, I mean, it's hard not to kind of agree with that, the essence of the point that you can get return, you can get a nominal return at least, and the Fed chair has noted that at least across the, from at least from tips, it implied that real rates are positive all across the curve, although I think that that's worth questioning. But that if you can get nominal returns in the 4% and change mark, depending on how far out you're going, with the current shape of the curve, that does change the environment. It's not any longer a rates must and will continue to trend down to zero and beyond, that maybe rates are actually where they should be or should have been and will stay in that area, and that does seem to change that paradigm. But yeah, that's just my, I guess, thinking on it.
You know, just to add on that, I think it's interesting. Like he point out a couple of things. I mean, it's pretty obvious, but he just point out that one, that Fed will kind of have to slow pace the interest rate increases, but is unlikely to return to a stimulative policy anytime soon. And he also mentioned that they have to maintain credibility, and therefore that's another point that he's making, that a lot of people talking about pivoting and stuff like that. That's kind of nonsense talk. And then he also the last thing he talked about is, the question is what to do about the balance sheet, and then that's something that we're gonna do is 4 trillion, 9 trillion due to bond purchasing, or without allowing the bonds to mature or to roll off. Those are type of like straightforward point that he pointed out. I mean, he didn't really go into what's the what's gonna happen if we're gonna maintain the interest rate in a target range for higher range, for a longer time. What will be the casual effect? I mean, I think something that I was hoping he mentioned it, like what's happening with FTC and stuff like that. And that might be just, what they call the tip the iceberg, but I was hoping that he talked about a little bit, diving into deeper about the after effect of it. But yeah.
Yeah, look, I think he lays it out, some of the details, that when you think about things like default rates, and he doesn't explicitly call out zombie companies in the memo, but that we haven't really gone through the part of the business cycle that we rampaged through from 2008 into 2009, that natural cleansing point in the investment cycle where zombie companies are taken out, and and you allow for that creative destruction. I would think it would be a dangerous bet to assume that the Federal Reserve will act disproportionately if unemployment rises modestly, and that companies begin to see an uptick in bankruptcy filings and restructurings. Right, the Fed is less likely, I think, in this environment to simply return back to that old world. I think I would agree with the theme of Howard's point there, but then it gets back to the timing of it all, right, and the noisiness of trying to be hyper focused on what one Federal Reserve meeting's implications are for the next. I think I would go back to the importance of really doing that deep due diligence on individual equities that you're interested in, having a list of those equities that you're interested in investing in for the right, price. And, to Jimmy's point, it's very easy, I think, for us, for retail investors who've spent a lot of time on researching a particular security, to then feel like there's some pot commitment that just because they've done a lot of work. The security, of course, doesn't care that anything or nothing about it. It's just an instrument, and it's certainly vital that you do those things so that when things get challenging, right? If we do see a challenging economic environment, that you have the conviction to either hold, cut bait, or other. But I'll pause there and let anyone else chime in.
Yeah, I've actually just added the Howard Marks memo from today in the nest on the space. So if you look at our Twitter space at the top, there's the link to view that, and you can view the insights that were released.
I was just going to finish my point here, since we're talking about books here. Just want to share one thing. I like one of the book I liked. I mean, we're talking about most important thing, but I also like to reading the Master Market Cycle. Yeah, there's a lot of quotation talk about the most important thing, and in one of the chapters, it talks about his experience during 08 CFG, when they started to buy distressed debt immediately after Lehman filed for bankruptcy protection in mid 08, And one of the point that I would like to share about is talking about he was talking about what was different between what do you think is a good time to buy while you're not catching a 49 here, and he's talking about 3 points. But say you need to be successful regarding to I'm quoting him here, to talk about an estimate of the intrinsic value, and B, emotion fortitude to preserve, and C, eventually to have you estimate of the intrinsic value to prove to be correct. So just want to share that.
Yeah,
The
Steve,
writing you
I'll
wrote.
kind of expound on that. So you're right, from the reasonable expectations chapter, he does talk about that a bit in the most important thing too, that, for example, you're right, they started buying distressed credit before the bottom, and he makes a point that, we never. I'll read the verbatim. Oaktree never says, quote, "It's cheap today, but we think it'll be cheaper in 6 months, so we'll wait," unquote. And he says it's just not realistic to expect to be able to buy at the bottom. So, I think that's where, these psychological phenomena of people don't want to buy the falling knife or catch the falling knife, right? I know Klarman chimes in with a few thoughts in line with that, these, especially for larger investors, right? If you're a retail investor, obviously you're unlikely to influence the security price, but if you're a larger entity, you want to be able to enter when there's periods of high volume, so that you're not finding yourself competing against yourself to bid up price. So they both make that point that, when there's these distressed sales, you certainly don't know where the bottom will be, but if you've got that idea of intrinsic value in mind, you think that it's cheap based on your assessment and analysis, that you should be buying, and you should keep buying as it falls, and not be worried about buying the bottom. And obviously he's doesn't talk about technical analysis in his memo collection for a reason. Obviously that's something that people can have a vigorous debate for or against, but yeah, I would totally kind of agree with that line of commentary. Just a time check. We're going to let the conversation run another 15 minutes before we wrap. So it will be available for replay both here on Twitter and on our YouTube channel. If anyone in the audience wants to chime in, ask any follow-up questions, please raise your hand, come up as speaker. You're certainly welcome. Otherwise, I guess we should start to wind things down, and maybe, Joe, you asked me what my main takeaway was, so I'll turn that around on you, and I'll ask you what your primary learning and takeaway was from the book.
Yeah, I mean, it honestly was the theme that I mentioned earlier, which is that, just because an investment is good doesn't mean it's it's priced. If it's priced as if it's great, then that is a discrepancy there. And in the same way that if an investment or if a trade has this potential to shift the sentiment, and you could have something that's being priced as if it's terrible, but it's actually not that bad, or it's just bad, there's some potential there. So for me, it was that if something is priced as if it's a great investment, but it's only a good investment, then it's a bad investment. So you kind of have to look at the ability for a stock to be overpriced, even when it's a great company. It's just priced as if it's a perfect company.
Han, putting you on the spot, what's your biggest takeaway?
Yeah, well, while Han probably figures out how to mute his mic, I will add, if anyone wants to suggest the next book, we have a thread open on the Wook.gg Discord server. Anyone can suggest the next book. We haven't picked anything out yet, so feel free. Typically, things in the business, investing realm is what we focus on, but open to all suggestions. Sorry, Rod. I was doing a quick gargle to disinfect my after my wisdom tooth
Oh, your
surgery.
poor wisdom teeth.
Feeling much better now, though. So my final quick takeaway. I just want to bring back the quote from Howard. Never forget the 6 foot tall man who drowned crossing the stream that was 5 feet deep on average. So this really, this quote hits home for me because a lot of us think that once we are once we are above 6 feet, we think that we can just cross the stream, on average that's 5 feet, right? It's common to think that, and it's a really big fallacy because it brings back to the point that people's perception of risk is very different, and oftentimes it's wrong. So at the end of the day, all we can do is to keep the discipline and keep learning, keep thinking about how we can hone the skill sets to have more conviction in the intrinsic value of the company, while also paying close attention to the market sentiment and perception, so that we have an idea of, even though the stream is on average 5 feet tall, we would have an idea on when it's going to go deeper or lighter, and kind of prepare in advance to make sure that we cross the stream. So that's my takeaway for this book.
Thanks, Han. Yeah, I hope your wisdom teeth are finally remedied. That pain can go away. As somebody who's dealt with unfortunate oral issues in the past, I empathize. I think the cycle aspect, like, it's something that's so vital to kind of keep in mind. And I mentioned early on in the conversation my own experience being in high school and blowing up a trading account around the time of the great financial crisis. That was for me an incredibly valuable lesson, even though it felt extraordinarily expensive at the time. Kind of that recognition that these things do move in cycles, and that if you can at least get a good sense for where the cycle is, you can minimize some of your risk taking and hopefully achieve some outsized relative return. It again, it was, it's like, oh, it's so obvious that 2001, 2021 was this inflated bubble point in time, yet why couldn't we all identify it in the moment? It's really hard to say. And if we think back to like 2007, Howard was writing about it for a few years, and people were betting on these things for a few years. If you're going to make a bet like that, right? You don't need to make explicit bets. You can opt to hold on to cash and not necessarily say that the sky is going to be falling. You could simply say that things don't meet my discount to intrinsic value, and I could wait for the cycle to move further along, and let that pendulum swing back toward excessive pessimism before I feel the need to invest, for example. But John, I'll let you. Actually, JP, how about for you? What was the most important takeaway from the most important thing for you?
For me, it really was the psychological aspect that the book covered. They talk about the efficient market hypothesis, where pretty much everything's priced in, private and public information, and everything's just perfect. So you can't really make profits, but you can when the market is inefficient. But both of them both exist, and it's just a matter of degree of which is more. So, but when it is inefficient, that's when we can make the money. And how does that happen? Well, that's due to the psychological aspect, right? We talked a lot about that today. People aren't always objective. People are greedy, fearful, or whatever that might be. So I think earlier we talked about how we can keep our mental state disciplined, and it's really about putting ourselves in the right place so that it is easier for us to stay disciplined. And he really talked about this in chapter 5, right? How do you measure risk? Well, that depends on the person and what kind of situation they're in, and that's really what defines risk. So I think as long as you put yourself in the right place, you're less likely to mentally break. So because that's really the most important part. We may be able to learn all these things and try to apply it, but if we can't stay disciplined, I feel like none of this really matters. So I think
And it's so easy to say. It really is. It definitely requires so much focus to maintain that discipline and not straying from our investment processes and not letting the highs and the lows, impact us too much, which again, it goes without saying, it's easier said than done.
yeah, and like kind of like what you were talking about earlier, catching a falling knife. If your calculation is correct, you should essentially be buying more if it's going down. And but people tend to do the opposite. And one of the quotes that I really liked was the market can remain irrational longer than you can remain solvent. So I mean, like, so even if it goes down, if your risk levels are in the right place and you have a strong thesis, it should be easier for you to have your psychological components in place. And if you are taking unnecessary risks and you're not in the right place where you would, all your investment would go, you get a margin call or whatever it may be, that you can't make the right decision, then you're just screwing yourself over psychologically and ultimately lose money. So for me, like, the psychological aspect was a really big takeaway in this book.
Awesome. Well, JP, thank you for that, and Han and Joe. John, I'm going to tee you up to share both your primary, I think, takeaway from both the book, from your conversation with Howard, and if you could just maybe talk a little bit about why we exist as Wook Capital and take us out on that.
Sure. Most important takeaway, I'd say how to make decisions, good decisions in the face of uncertainty. I think I touched upon this topic a little bit before, but I don't really think about the outcome anymore, but rather the potential outcomes that are possible and the probabilities associated with them. Not literally, of course, but I just ask myself, hey, is this a good bet? Whether it's an investment or an important decision that I'm making on life, and then the outcome's the outcome. I don't get upset about what happens unless I look back retrospectively and say, hey, this wasn't the right decision with the information that I had at that moment in time. So yeah, as for Wook Capital, we exist. I mean, our main goal really is to eventually create a community and an ecosystem in which people can offer their own input to the point that we crowdsource very valuable information and create theses on our own for where it could be stocks or bonds or whatever that we want to invest in, and the end result would culminate into multiple different projects that we can put out publicly and have a lot of different people chime in on that as well. So the idea is that I think most people think finance has to be a zero-sum game in which one person has to win and the other person has to lose. We don't think that way. We think everybody can win, and in this day and age, in today's day and age, it's more important than ever that we work together.
Great. That's a great summary. And just to kind of share again for folks, we're a private investment fund, but we, at our core, genuinely believe that crowdsourcing research with other retail investors will enable all of us to achieve alpha through realizing better investment theses, becoming more informed, uncovering nuggets of knowledge that the market has overlooked. And we need to continue to test this out. We invite you to be part of our community. There's no, we're not selling anybody a service. We never will. We are simply looking to collaborate with and share information and knowledge with other investors. And you're welcome to dive into our Discord channel, wook.gg. We will continue to put out what we hope is valuable content in our Wook in Review this week. We hope that folks will respond to this year-end survey so that I may better know the sorts of social content that Joe and I and the rest of the team should be producing for investors who want to be part of our community into 2023. We've talked about, and just to kind of recap, we publish a weekly, what we call Wook in Review, where we recap some of the week's highlights in the business world and some topics that we do a bit of a deeper dive into. This is our second monthly book club. that we anticipate we'll continue to do on a monthly basis heading into 2023. And we will be covering, we've covered a couple of earnings calls. We did that for GME. We did that for PLBY. We anticipate that on an ongoing basis, we'll begin to have a quarterly cadence for these different companies that we cover from a importance in the economy perspective and also companies that we find interesting perspective. So more to come from us on that regard. We genuinely appreciate everyone who chimed in as both a speaker and who took the time to listen in on the conversation today. Again, if you have any feedback and you haven't yet signed up for our newsletter, the Wook Capital handle, if you go to just click in there, you'll see a little newspaper.wook.gg. That'll bring you right to the MailChimp so that you can sign up. And when you get it in your inbox on Friday, we would sincerely appreciate your feedback. So with that, I'll call it quits on our second Wook Book Club. We sincerely appreciate everyone for joining and making this happen as we covered Howard Marks' The Most Important Thing. And hope to see some of you next month when we're back after the holidays. Cheers, everybody.